Welcome back, everybody. So, today I'm going to be talking about how your business equity feeds into your individual tax return when you are a partnership or an S corporation. So, if you have a 1065 done or an 1120S, this is for you and you really need to be listening. Quick story, in the last week, I've had to have two separate conversations with two separate clients about why they owe taxes when their business either didn't make very much or incurred a loss. So, in one case, the one that did make some money, they did have a profit that should have equated into $24,000 of taxes. Because there was an equity situation, they actually wound up owing $55,000 in taxes. And in the client's case, where they actually incurred a loss in their business, they actually wound up owing just over $4,000 in taxes. And it's really frustrating for these people because they don't understand why. And it's clear that the professionals who were advising them do not understand it as well. Now, in both cases, the professionals advising them were not CPAs and clearly did not have a strong handle on business equity when it comes to these particular business structures. So, first of all, I'm going to explain what equity is, and then I'm going to explain how these people wound up owing money and why it's so important that you watch out how much money you take from your company. Okay, so first of all, equity is an amalgam of various different factors. So if you are a business owner who takes money out of their pocket and puts it into the business, very often called an owner's contribution, shareholder's contribution, or owner's investment, then your equity goes up by the dollar amount you just provided. Now, it's really important to note that I know a lot of you have sweat equity in your businesses, but your time does not factor into this, only the money you actually put into the business, okay? Now, your equity goes up again when your business makes a profit, and it goes up by the amount of the net profit. Now, there is a difference between book equity and tax equity, and I'm not going to get into that right now, but it is important to note that there is some slight differences between the two. Now, your equity goes down when your company incurs a loss or the owner takes money out of the business. So it also goes up on liabilities. Like, so if the company owes money that you are personally responsible for, then your equity increases by those liabilities as well. Although I'm just going to keep it really simple and we're just going to focus on the first four. Okay. So what happens is you can continue to build equity in your company and you can take draws out of your company with limitations for these two particular business structures. There are limitations, but you can continue to take money out of your company until your equity is zero. Okay. Now, there are a couple of things that then happen once your equity is zero, especially if you're a company incurring a loss. If your equity is zero and your company incurs a loss, but you continue to distribute money from your company, you have just created what is called a return on investment. And that return on investment is taxable income. And that is what happened to the client of mine whose company incurred a loss, but they wound up owing money. Okay. So that's what happened there. Now, with the company who actually earned a profit, did that profit feed into their equity? Absolutely. But this client has been taught that they should continue to take money out of the company, as much as they possibly can and use company funds for a lot of things that maybe they shouldn't be. So, what happened in this case is they didn't have equity to begin with because they have a history of taking significant owner draws from the company. And then this profit, while it did help, the problem is they took way more money out of the company than the profit that they incurred that year, and so it added an additional $31,000 of taxes onto their equity. Now, or onto their tax bill. Now, this is an extreme case. It doesn't usually happen this extremely, but here are the things that these two. Well, actually, here is the thing that these two clients had in common. And that is they each had professionals, and they were not the same professional. They were two separate professionals who told them, yes, absolutely, that company money is your money, draw away. And that's true to a point. There are other rules that go into this. And today I'm just focusing on the equity, but that is not the way anybody should be taking money out of their company. They should be working with the CPA to make sure that it's not going to have the tax impact that had on these two particular clients. Now, this is something I see regularly. And ultimately, the bottom line is the two professionals who actually advised these people that they could take as much money out of the company as they wanted were not CPAs. Okay, that's really important to understand. Almost anybody out there can go out, call them consultants, call themselves a consultant, call themselves an accountant, but not have the certifications to back it up. So this is one of those things that as an owner, caveat emptor, okay, buyer beware that you are careful to be getting the proper information, because I can't go to the IRS and say, well, I don't think they should owe this money because they got bad advice. Now, I can do a little bit with bad advice, but for the most part, the IRS is like, educate yourself. So hopefully you're watching these videos and you're doing that. Really important to be very careful. I see this go badly all the time. If you have an S corporation or a partnership, you can't just be drawing money out whenever you want. You need to do it strategically. And if we do it strategically, there are a lot of things that can be done for tax planning purposes. Now, this does not affect LLCs that are working as sole proprietors or sole proprietors. The only way sole proprietors get money out of their company is through taking these draws. So this does not apply to you whatsoever. So if you are in a situation where you are just pulling money out of your company all the time, please call me. Let's analyze this and let's make sure you're not creating a tax impact. Neither of these people really understood what was happening. One client, the one who had the most extreme case, just did not understand why they owed so much money every year because they didn't really feel like the net profit was actually justifying that amount. And I was able to explain it through the draw of equity from their company. Keep that in mind, super important. It's happening all the time. And if anybody ever tells you that you can draw as much money out of your company as you want, stop, think, and come see me. My contact information is always on the back end of this. Okay, so next week I am going to be talking about Cash App, Venmos, basically all of those apps where you can easily move money from one person to another. Makes it super simple. The rules are changing on that. The IRS, the government has its hooks into it, and they're going to be watching out. So be on the lookout for that video next week, everybody. Take care.